Ours is a job to make exceptions. You first make the rules and then you make exceptions.
You have 4 unicorns today in your portfolio. Which one are they?
Unacademy, Spinny, Purple, and Slice. When you look at these companies at the early stage, you consciously need to make sure that you're not scarred by your failures. There is always going to be, you ask for one, I promise you will discover 4 reasons why you should not invest in a company.
Yeah.
And you will get those 4 in the first 20 minutes. Instant gratification and sense of entitlement, both you have to do away with if you have to succeed in the ecosystem.
What is sense of entitlement?
I am IIT plus IIM. 5 years worked in 2 of the unicorns.
Yeah.
Third unicorn is willing to give me a job. So you have to give me a crore. Instant gratification is I don't care about carry. I don't care about ESOPs.
Yeah.
And I want everything in the salary today. That has to go.
Yeah.
Sense of entitlement is that बनता है नहीं चलता
और ये मिलता आया है.
तो क्यों नहीं?
Hi, this is Siddharth Aluwalia and welcome to the Neon Show. This episode's guest is a chartered accountant who previously worked at SBI. He is currently a partner at a VC firm that raised more than $250 million in its 4th fund. Some of the VC's most popular investments include Unacademy, Dunzo and Stage. It's my pleasure to welcome Blume Ventures, Ashish Fafadia on the Neon Show. I would also like to thank our sponsors, Prime Venture Partners, for sponsoring the Neon Show. Hope you enjoy it. Ashish, welcome to the podcast.
Thank you.
So excited to have you.
Pleasure being here.
And it's great that, I first pitched to Blume in 2014 for my own company. I had the IC in your Mumbai office, in IC's investment committee. And I met the entire Blume team. I met you, Karthik, Sanjay, Arpit, right? And by 2023, now today, like almost 9 years, Blume is a limited partner in Neon Fund. So excited to come to a full circle with Blume and have that great relationship with Blume. So for our audience today, right, I want to start with the history of venture capital in India, how venture capital entered India, right? So do you remember the early days of venture when ICICI Venture was just formed in 1999? Westbridge was formed in 2001. And then slowly and steadily, the global fund houses started opening up shops, or their partners keep on traveling to India. Would you like to deep dive on your memory?
Yeah. So I think if you look at venture in India, we have to also have a small preface to the tech ecosystem.
Yeah.
And tech ecosystem, the way we see it, is not what existed, or that's not how it started. Globally, there are 3 large ecosystems. One is US.
Yeah.
Second is China. Of course, we are now number 3.
Yeah.
But there's a fairly active ecosystem with Israel.
Yeah.
On the deep tech and related side. When back, it all started with the services boom.
Oh.
And the offshoring that came along with the services. India had a pretty good advantage with English as a language, emerging mid-market population, and it was natural for a fair bit of effort done in the 70s and 80s by the Software Manufacturers Association, hardware manufacturers. Eventually NASSCOM was formed. So those 20 years, 25 years of effort did create a fair bit of software boom in the country, and that was largely around offshoring of services. There was largely around software services being done. And in the process, you had the giants that of today, of like the TCS, Infosys, Wipro, and the likes created. And which meant that you started to have a very high quality engineering talent.
Yeah.
You started to have hubs and centers developing around a certain diaspora, which is apt at coding. There was an infrastructure created to create more and more engineers, which is why hubs like Bangalore, they've started to see that we cannot take care of our needs from Bangalore alone. So people started looking a little other direction. Came Mysore, came Hyderabad. So the hubs in India started developing, and you saw pockets where a fair bit of tech talent, engineering education, and all of that bolstered. So it wasn't that all of this happened during the 90s and continued through the next 20 years. And in that batch, in that vein, what was parallelly happening is also the entire Y2K bug and the hype and we saw ICICI Ventures coming and starting up.
What was the Y2K bug?
So this was around the year 2000.
Yeah.
You are used to seeing the DDMMYY as a format.
Yeah.
So you say that, okay, if it is 15th August 1999, it is 150899. And now the date change will happen on 31st December 1999.
Yeah.
So from 31-12-99, you're going to change to 010100.
Yeah.
And that is not something that the software would probably recognize was the fear. And so it was year Y2K. That was the whole bug. There was a fair bit of attention around that, and there was a fair bit of hype around it. Is what I would say in hindsight. Back then, it was a fear of unknown.
Yeah.
So bunch of things started to happen where Indian market started to receive a fair bit of attention as well.
Yeah.
Apart from the ability of Indian talent to take care of global needs by way of offshoring, outsourcing, body shopping, software coding and all that, people started to feel that this is the time and age where Indian markets also are going to be big enough, and people would start having a plan to allocate capital into India. And it is with that you saw the first batch of actual pure play VCs looking at it.
Yeah.
We had some form of funds allocating capital to India, but they were all domestic centric, looking at more private equity format kind of investments, project based investments, SPVs and all that. A lot of it would be government originated, nothing on the VCs per se. And I don't want to delve too much into the history, but since you asked, maybe a minute more.
Sure.
It was on the back of this that you saw some fund managers coming to India. In Bombay, they would stay in one of the Nariman 0.5 stars.
Yeah.
We didn't have BKC as an area developed back then. Or they would look at Bangalore and they would stay in a hotel, meet people, invite them over, make their decisions, allocate small checks and go away. Westbridge was around the same time. There was ICICI Ventures which came about, and these sizes were tiny. Do remember, back through that decade also, there were 2-digit IPOs hitting the markets where people would IPO at 65 crores and 85 crores and 100 crores, and it would still be big enough. That is how small and nascent the Indian capital markets were, leave alone the venture market, right? So that's the journey that we have covered in the last 18, 17 years. And in that same phase, there was a brief lull because 2-3 things happened. India went through a bunch of nuclear tests. There were global sanctions against India. The Y2K hype was over. So the over allocation to tech, software and all that kind of started to fall flat. Because of the sanctions, there were limited investments happening into India and the market development was not going to happen. So it became like a vicious cycle, which was going to take a fair bit of time for us to come out. And post that, when things started to look up and again India went back, by then you had the few other companies seeded. What we see as companies like Naukri, InfoEdge and all that was seeded by then. And they were already doing their own bits to figure out. Internet had taken center stage over the next 5 years, from 2002-03 to 2007-08. What also started to happen is a few other funds had kind of emerged. A few other foreigners kind of set up a shop, or they would. But you could you could still count on fingers of maybe now not one hand, but fingers of two hands. So what was looking like 3, 4 looked like suddenly maybe 7, 8, 9, 10, nothing more than that. And there was some bit of angel activity also happening. So people would congregate in a lounge in Bombay, 20, 30, 40 people, and say that, okay, let's see some companies. So on a Saturday afternoon, I remember going to Chopati where there was this Karma lounge, and we had 4 startups pitching back to back. That's Karthik and I both were together at that time. Karthik was asked to represent the Times Group because both of us were working
2006, 2007?
This was 2007, 2008, just before the global financial crisis, what enough people jargonize as GFC and all that. So you would look at companies. Apps was not yet a word back then. We were still, mobile was not key and left, right and center of development and ecosystems for selling, marketing, consumption back then. It was still around internet. It was still around computers and development and commerce centric opportunities. And people would try and look at those angel investors. Similar efforts sprung up in Bangalore, Delhi, later on Chennai as well. But this was sporadic activity. There were a few funds operating in isolation, some bit of activity happening. The likes of Flipkart had been seeded. You had the likes of InfoEdge would have a little more clearer, fleshed out journey. Just Dial had morphed into, already on the path to what it is morphed into today. So those kind of germination, seeding kind of efforts had already begun.
Got it.
Fast forward 2010-11, when we were still not having an original grounds up India-centric funds. We did have a little more effort from the 8-10 that I mentioned, fingers of two-hand analogy. We had a few more where from abroad or US or China, they would have some single GP, a single LP. LP means a limited partner, the borrowed construct from US, which I mentioned. They would have a single LP fund and say, okay, I'm carving out $25 million or $50 million, have somebody manage it into India. There were those kind of efforts which were already taking shape. But no grounds up India-centric VC capitalized from India. You were still banking on foreign capital because India didn't understand that risk. Even if India understood that risk, I don't think we were ready to look at something which is so binary. Even until 4, 5, 6 years ago, I don't think I would even caveat by saying take it with a pinch of salt. No exaggeration. Enough people would say tukka hai when they talk about early stage VC. So people were not ready for that kind of a binary outcome where things you are going for all or none kind of a risk. But at that point in time, there was a thought process when there was an activity which we could see with the angels, etc. That after the angels, you literally had those half a dozen funds to go to. So there was a valley of death, which means you could raise money from FFF, friends, family and fools. And you would raise how much? Some people would put in 2 lakhs, 5 lakhs, 10 lakhs. I remember back in the mid-90s when I would look at some balance sheets, because I was part of an advisor firm trying to do my formative years of training and internship. The job was to audit, right? They would be on those pharmaceutical companies, on hospitality and distribution companies. You would see people who had given in 10, 25, 30 lakhs. But for these kind of tech businesses, when an entrepreneur is pitching, he's coming with no background. The examples I am talking about where there were entries of 25 lakhs on the cap table. Cap table means the capital structure of the company. You were still found entrepreneurs who were in their 40s and 50s, some track record. He's going to inner circle. He's going to a little bit of an external circle and trying to raise some money. But here you're talking about entrepreneurs in their maybe late 20s, early 30s, mid 30s, moving out of a job, no business experience at all. And he's going and asking money from people who was not known at all, right?
Completely strangers.
Absolute strangers. So people who were used to seeing friends and family raise 25, 50 lakhs and build 10, 20 itemized cap tables and then kickstart a pharma business, like I said, because that was a nature. You were trying to create a business for exports. You were trying to create a business for serving the Indian consumer. So Indian market was always, the way Blume has looked at the Indian market is always these two parts. Indian talent building for India, which is building for the Indian consumer, or Indian talent servicing the globe. That is it. And it is translated on the tech side to Indian engineering serving the globe, which is B2B. And Indian platforms servicing the Indian consumer, which is the B2C, right? So this was not something which was people were used to, where a complete stranger will come and say, I want money. So these people would have an incredibly arduous journey or a tough journey to raise money. So people put in, guess how much, Siddharth?
I don't know.
I have seen cap tables
Okay.
where people have contributed.
50,000.
Those were exceptions.
Yeah.
But single digit lakhs was very common.
Okay.
2, 5, 7, I have seen umpteen number of entries. And yeah, there were equal number of 10 and 20 also. But what was the minimum for a conventional business entrepreneur, second generation guy to win over from friends and family? For a fresh guy, first time pitching business to a complete stranger without track record, no business, no P&L, no cash flows, that same 25 minimum came down to more like 5 or 10.
Yeah.
Right? So this is 2010-11. This caused the valley of death. That you will have 10-20 people who have given you 2, 5, 10 lakhs. So you've raised 50 lakhs to 1 crore. After that, you don't know what to do.
Yeah.
So it was with that vision Blume was created, that you were going to come in at that valley of death, be the first institutional investor on the cap table of the company. And the fund kicked off with a vision of raising $20 million. Now, remember, we have reached 2010-11 in the journey of Indian VC. The Blume journey has an interesting semblance with the Indian VC. We can continue talking about that for a few more minutes if that's interesting.
Yeah, absolutely.
So it was in that vintage where exchange rate was what? $1 was in the 40s.
Yeah.
So it apt for me to say that $20 million fund, 100 crore rupees, but it would still have been a little less than 100 if you got the full 20, because we were not 50 rupees to $1.
Yeah.
And today when we talk about the dollar rate, we are in the 80s.
83.
Right? So it's almost doubled.
Yeah.
That means thankfully we were not having dollar capital, but if we had dollar capital, our returns would have halved.
Yeah.
So that's the impact of what you have to deliver as a VC. That's why the VC expects what he or she expects from the founder. We can talk about that anchoring a little later. Because that is an implication of when you take money from a VC, when you pitch VC to a founder, why certain terms came. There have been scientific reasons why some of these have been there. So coming back to the history. So 2011, we pitched. People said, we can't give money to a first time fund. Because who do you go to? You go to an institution. You go to a fund
Which kind of institutions you first went to?
This is US. So because that's a market that understands the risk. Yeah. China was still a new and unknown, uncharted territory for India. Barring a brief decade plus where we had China, very healthy influx of Chinese capital, Chinese companies. Other than that, it has been a uncharted territory.
Agree.
Or unmarked territory. Nobody would even say that I'll go and raise money from China.
And if you can remember in 2011-12, the limited partners which every Indian fund aspired in the US, who were they?
The usual. So the institutions that the likes of Horsley Bridge and the peers or endowments were the typical bodies that people would want
What's
to raise.
What's an endowment for our audience?
So you have a university,
you
have a Stanford, you have a Oxford, you have a Cambridge. They will have their boards and they'll have the pots of capital where people will come back and give in the money.
Contributed by their
alum. Contributed, or they have created their own surplus by launching certain programs which are customized. So the pool that has been created, either contribution of these 2-3 sources put together, is what forms the endowment pool. Then they start allocating those for causes which are in their charter, in the document. And then those pools start multiplying over a period of 50, 100 years. These are pools that have existed for 50 plus years. Some of them have been even for 100 plus years. And these are the pots which people typically aspire, because these have an infinite duration. These are of course, they will come and enforce a 10-year life, which is a typical VC life. But patient capital, long-term capital, once these institutions come in, unless the manager really has messed up, these people are going to support you again and come back and say that, okay, now you're raising a bigger fund, I'll give you more money. But size creates a big issue as well. So just imagine that you are today deploying out of a 100 crore fund, you will be happily cutting 3, 4, 5 crore checks, or maybe even 1 to 2 crore checks. Instead of 100 crore fund, you have a $100 million fund. Are you going to still cut 1, 2 and 3 crore checks? You will not. You will push the bar a little higher, and you will still do early stage, you will still do seed, but you will go for a different set of opportunities. There will be a lot of those tweaks that you will do so that you are tweaking and delivering, doing justice to $100 million pot. And these are pools which are 1, 2, 5, 10, 20 billion dollars, right? Some of them larger than that as well. So naturally, when you say that I'm a $20 million fund, they will say my minimum check size that I want to invest into you is more than 2x than your fund size. So your fund size is 20. I cannot deploy 50 million. For 50 is something which I want to deploy. So 3 things. 1, your fund size is too small. 2, even if I can do, let's say you will say, I want 50, okay, no problem. But what do you know about VC?
Managing 50.
You have not managed other people's money ever. OPM and OPM, it's very similar, right? OPM is other people's money. So very similar to that sense. So even if we could, we cannot deploy more than 20-30% in a single fund. So if you're a $20 million fund, the max I can do is $4-5 million, or 20-25%. So sorry, not the right thing for us. And then you go to the large format family offices, and there are a huge number. If today India boasts of a few tens of those in a structured format, Azim Premji Foundation downwards or Premji Invest downwards. In the US, you have the Rockefeller Foundation downwards, and hundreds of those, right? Larger ones have a similar predicament. And they will also, all of these institutions have been so scientific in their approach because they've been investing for the last 30-40 years, or let's say 20-30 years for sure. They have seen the US ecosystem set up, go through a big phase, and then crashes in the US ecosystem as well in the 90s and the post Y2K scene. They have seen the China ecosystem and how that kind of reached a big inflection point and started to emerge. They have seen corrections in that market as well. So they are very well aware. It's like a reinsurer. You and I feel that my life is 100 years guaranteed. But insurer knows that average lifespan is 72 years for a male, 67 for a female, whatever. The numbers have changed now. Reinsurer knows even more than the insurer. And a global reinsurer knows even much more than a local Asian reinsurer because of their exposure. This is data of 15-20 years ago. Now, of course, Asia is getting at par with in its fair share of economic contribution. Still lagging, but catching up. So as you go higher, you are seeing much more data. You are seeing much more patterns, and they start evening out rather than when you see from a distance as just one-off cycle. So these people are not going to play a first-time fund manager. They'll say, you please learn and come, I'll do second-time fund.
Okay.
So then you come back and say, okay, I'll go to individuals. Individuals don't know you. They have no way to diligence you. It's not worth for them to allocate 5-10 crores and say, we'll diligence and all that. They don't have the wherewithal, interest and time and patience to do all of that. There is a validation that an individual will like to have. So then you are back at your home base. Enough people gave good advice pragmatically that you should go back to your home base. And just to give a context to everybody that this is 2011 that we are talking about. 10, 11. We got a license in 11. 10 is when Sanjay Karthik shook hands and kicked off. And that point in time, enough people gave good feedback saying they're raised from your home base. We would like to see you, but with some track record. Track record is good enough that you have created the first batch of portfolio. You can showcase to us as to how those companies are doing. All of that is fine. But at the end of the day, it is important for us to see your ability to create a portfolio and the cadence that you build to nurture a portfolio, investment approach, support to the portfolio, ability to make an exit decision. So by the time you reach 3-4 years, you will reach that juncture. So come back at that point.
And they are in no hurry to deploy capital.
Absolutely. So anybody who's sitting on capital knows very well that the best investors don't have FOMO. It's a different thing that in 21 VCs caught up FOMO. But that's not what happens with the best of the breed.
I'd like to take one example. I'm just forgetting the name. He's an early Google employee. He raised his first fund of 8 million 2008 that invested in Twitter, Uber, and all these.
I know what you're talking about. I know who you're talking about.
What was? I'm just.
No, I'm not able to catch the
Yeah,
name,
yeah.
but I know what you're talking and who you're talking about.
Yeah.
There are those kind of
Exceptions.
the exceptions.
And that 8 mil.
But if you look at our own case studies, right?
Yeah.
We are now a decent system
Yeah.
where we have a few interesting case studies. So, talking about Erasmic,
Yeah.
which now is known as
Axel.
Axel. That's the Axel India team. Their Flipkart story is something which is remarkably similar in terms of the returns that it generated for them. So there is a fairly healthy track record of having cracked 2-3 good companies in the same cycle, and the fund has astronomical returns and scale.
The fund produced that fund I'm talking about, the 8 million fund returned back 600 million to the LPs.
That's a clear aberration and something which is going to be hard to repeat. And
it's hard to repeat it.
But there have been enough cases where people have returned 8, 10, 12x on funds.
And you're saying the domestic Indian funds have returned.
Yeah. So had today, even what that happens on the back of 2 or 3 companies returning a spade of the fund, multiple of the fund, right? Even today, when we look at our fund 1, we have one company that is one time the whole fund.
Okay.
It's a dragon outcome.
Okay. Which one would that be?
Give me a week and I'll tell you more about it. We are on the verge of announcing it. So
this podcast would actually come out after 4 weeks. So
after 4 weeks?
Yeah.
Okay. So this is Carbon Clean.
Okay.
And it has done incredibly well.
Yeah.
And we are anticipating one more to go down a similar path. If we were not constrained by the time limits and we had little more time, we would have had Purple also deliver the same outcome for us. Similarly, Turtle Mint. So imagine I'm talking about Blume, which is a 12-year journey, where I've quoted 4 examples where a full fund return can be generated. You can turn around and say, but it is 13 years. It's true. But in 13 years, there are 4 companies in that fund which each have generated a full-time fund. It's a different ball game that we have already exited Purple out of that fund because of time constraints that I explained. Similarly, Turtle Mint, which has been exited, and the other 2 are real. So even if we had taken 12 years or 13 years, so what? You have 4x of the fund from 4 companies. And then there are another dozen companies which are anywhere between 0.2 to 0.3x.
Got it.
Right? So now you multiply. Jolly well, it is a 8-10 bagger. So it is possible. It is not impossible. It needs a few things to happen right and a certain cadence to build out. It's possible. The best breed is that. What we are trying to do with our secondary fund is exactly to prove that, Siddharth. So in fund 1, we basically were having a visibility and conviction that there are at least half a dozen companies in the portfolio that potentially can deliver that kind of an outcome. It was with that spirit that we went and raised a continuity fund so that we could buy out those companies and not
Purple.
get like Purple, Turtle Mint, so that we don't have to get constrained by the fund duration. We can transfer and hold them into a new vehicle. And those investors who choose to come back can continue to enjoy the upside. I am promising to you that the names that I said will deliver holistically on that aggregate fund size, the full outcome as well. So when you take a 15-year horizon, look at the compounding effects and the multiplier effects that take shape. So it is I'm quoting these examples live. I quoted one more example, which is another Indian story. Globally, the ecosystem is a lot more mature, so there are many more.
So let's talk about the kind of investors the fund have. When you mentioned about endowments, but endowment check sizes are pretty large. It's a 50 million check size for an endowment, and they would potentially like a 500 million fund to put a 10%.
If not 500, 300 for sure.
300 put to own 18% of that fund, 16 or 18%. Who are the next set of LPs below endowments in the food chain? Because venture capital is a food chain.
It is. So at the top of the food chain sits mega large family offices, endowments together. Then there are the next layer of family offices and fund of funds.
And like typically who are they? And what?
The example that I gave earlier, Horsley Bridge and many others. these would raise money from family offices, which
Yeah.
are larger. These would raise money from these endowments, and they would deploy on their own.
Yeah.
And then you would have another layer of the Western markets, particularly the US, are so large that you will have family offices in all shapes and sizes.
And what are the check sizes? Like the 50 mil check size is for the typically 300 mil fund size and
No,
above.
the largest ones want to have now reached a point where some of the sovereigns,
Yeah.
that's also big.
What's a sovereign?
Sovereign is a country's fund which they have set up to diversify their exposure. So oil-rich countries, or for that matter, cash-rich countries.
India has a sovereign fund?
SIDBI is as close as it can come to. So that's effectively our sovereign wealth fund. But the sovereign wealth funds as a purest construct gets created so that you can allocate countries' reserves into a separate bucket, call it a fund, call it an SPV, and you can use that to invest into other global assets and therefore diversify. So let's say, God willing, India will be cash surplus in the next decades to come. You will say that I'll divide my bucket into 2-3 parts, where I will have a part of it into other countries' infrastructure development, another part into other companies' financial investments, third part into developing trade routes between your country and that country of various kinds, not just physical routes, but IP and rights and permits, and incubating businesses into those countries, JVs between two governments. So it can be at a strategic level, it can be at a financial level, it can be a goal-based thing, depend to suit the strategic needs between that country and many other countries that it wants to. So that's a sovereign wealth fund. So there are sovereign wealth pockets. There are DFIs, which is development financial institutions. The goal of these DFIs is to take their state capital. Again, it has to be a surplus state largely, and part that money and into other countries' investments so that they can create a slightly more inclusive worldview. So they are trying to do it for a certain purpose and cause, and there are various agendas. So for example, there was a development agenda where UK took this approach that every country that at once upon a time where we were ruling, we would go and deploy capital, which is today that time known as CDC, now it is known as BII. So there are various goals with which some of these DFIs would come. But inclusion and a broad-based world order is what they are trying to foster. So there are these kind of bodies as well. Endowments, sovereign wealth funds, DFIs all come around the same. So it's a food chain. And below that comes the fund of funds, and then you have funds.
And tell us about, like you told about the first fund journey. In the second fund of Blume, how large was it? In which year you started raising
Fund 1 was 100 crore.
Yeah.
It took us 24 months to raise. 2011 and 12. It was only at the fag end of 12 is when we finished the fundraise. We ended with just short of 100 crores due to something. Because one investor simply said that, okay, I'm committing a little lesser. So we signed off and moved on. And no defaults. Second fund came in 2015 December.
Got it.
$60 million launch. First close.
Okay.
We were done. We did the first close with...
and when did you started raising the second fund?
We went to the market in H1 that year.
2015, first half.
Yeah. We went... So it took us about good 8 months to get to that.
But this was much faster and much larger amount.
No, you had a track record coming out. I will still not say it was a full track record. A fund manager's journey is 3x more complicated and arduous than a company's journey. Less binary than a founder's journey. So one has to balance it out. In a company like you have seed round, Series A and Series B, our fund 1 was our seed round. Taking an analogy that Karthik used once in a similar podcast. Our fund 2 was effectively our Series A. Where you could go around to institutions and say, look what I have done with my capital so far. And it looks like the dots are joining up. and the institution comes and says, yes, I'm willing to anchor you.
And with Fund 2, did you qualify for institutions this time after 4 years, or you didn't qualify?
No, we did. So Fund 2 was primarily institutional.
Okay.
So $60 million pot.
Yeah.
$40 million came from global investors.
Yeah.
And
40 million is pure fund of funds or endowments?
Combination of no endowments.
Yeah.
40 million came from institutionalized family office or people advised by individual advisors, professionals. Then corporate VCs who were looking at an exposure and diversify their interests into India. Then we had a small capital from a fund of fund, a small experimental check.
Sure.
And then we had a little bit from institutionalized family offices.
Okay. What's the difference between institutionalized family office and a family office?
The family owner is taking call largely. Okay. That's a family office. The family is an IC. Here you have a bunch of professionals running it.
Okay.
They will get a charter or a mandate from the family. This is how we want to deploy capital. And they are in sync with the professionals who are running it. Could be employees with a share in the carry, exactly like how a fund manager is doing. So in that kind of a setup, you will still have a family member on the IC. They could veto things. But largely, best of such family offices would come into veto only in the event that there is something which is sensitive to the mandate or something which is against the principles. Otherwise, it will be a bunch of professionals making these decisions along with a supervision and intervention by the family.
So you mentioned like 4 kind of LPs in Fund 2. The first is, can you repeat that? What?
There were family offices.
Yeah.
Which I'm breaking that itself into two family offices and institutionalized family offices, corporate VCs, and then you had HNIs. And the fourth one is our own homegrown institution, which is SIDB, which is an allocator. Yeah. We also had fund of fund. So these are the 4.
Got it. And you said 40 million of it came out of India.
That's right. That's 2/3 came outside of India, 1/3 came from India. And that is one way to divide this. Yeah. The other side of the 2x2 is how much was institutional and how much was retail.
Yeah.
So for us, out of the $60 million, almost 85-90% was institutional.
Got it.
And the rest of the was a long tail retail commitment. So we went from heavy retail capital to heavy institutional capital.
How did this DNA change? Because it is very interesting for fund managers on their Fund 2, Fund 3 right now to learn this.
The ambition from day one was to be institutionally dominated.
So you were meeting these institutions right from 2011. You kept on meeting them again and again.
The first of the institutions were met in that phase of 10, 11, 12.
Yeah.
And we did keep
them updated.
A fair bit of pace with what's happening in the markets. There was a cadence of trips. It typically takes, the fastest I think we have converted an institution. There are exceptions, but the typical is 3 to 4 years.
The fastest you have converted an institution is 3 to 4 years.
An exception would be there, where we have converted an institutionalized family office. I'm calling them as institution, just to simplify.
Sure.
Then it's 4 varieties like you asked me earlier. The fastest we have done technically is still 4 months, but that is an exception.
Okay.
Because most others, the median has been 4 years. And there have been couple where it has been 7 years. There have been couple where it has been more, 10 years.
And how many meetings?
So we first met these people during our Fund 1 post fundraise update.
Yeah.
And could convert them only into Fund 4.
Okay.
So one should remember 3-4 things, just as a quick summary. Number 1, you are likely to have somebody come in when you meet in a fund. It is a probability that they'll come in this next fund when you met them in Fund 1. They'll come in 2 or 3 or 4.
Yeah.
And there are many who we have not got in Fund 5, Fund 4 also, and might not come in Fund 5 also.
Yeah.
Second is, in that intervening period, the minimum number of engagements that will be required
Yeah.
will be at least 6 to 10.
Okay.
So if somebody has taken 10 years, you can imagine that there would have been 10 meetings.
Yeah.
Nothing less than that. But the minimum is half a dozen plus.
Yeah.
There was some LP who gave this insight that there's almost like a rule of 7 hours. So unless the GPs have engaged with an LP for 7 hours,
Yeah.
it's hard to convert, because you need that kind of a time and depth to understand the whole thing very well.
Yeah.
And it's not that you do a morning, evening 7-hour thing. That 7 hours has to come spaced over at least a 3-4 year cycle.
Yeah.
Sometimes 14 hours over a 6 to 8 year cycle,
Okay.
depending on how things have shaped up. And the last thing I would say is that the institutions will always come with a dual yardstick. The minimum threshold they need to cut as a check, and the maximum threshold that they will not cut as a percentage of the fund size.
Yeah.
So some institution which has a minimum threshold of $25 million and they won't do more than 20% of the fund, by default it means $125 million fund size. So it is important for the fund manager to know that I cannot get money from this during my fund if I'm raising less than that.
Yeah.
However, we learned it the hard way. That's once in a while, everybody does have a program. Like funds will have a program, like we have a program of BFF.
Yeah.
People do carve out their equivalent of a BFF and may allocate to a fund.
For our listeners, what is BFF?
BFF is the Blume Founders Fund,
Yeah.
which is our way of making sure that we're able to keep our relationships and nurture them through, in case we are not able to do a core $1 million to $3 million usual check that we like to do. It's a much smaller check. It's a check just for the sake of preserving our relationship. It's a check which we will never be able to follow on and go deeper. And some aspects of work that we do as a part of the platform, we may not be able to do the same.
Yeah.
But it's something that idea is to signal to the founder that we care enough that there is some amount of capital which is still on the table for us to have a relationship.
Yeah.
We will still be meeting at the Blume sponsored events. There'll be some parts of the team engagement still available, but it will be not a full suite of things that may be possible. So that's a BFF.
So what do you think went right for Blume that the 60 million came from large institutions?
3-4 things.
Yeah.
Fund 1 had a few companies which were starting to look like decent sized outcomes. So one could look at the portfolio and say, okay, your robotics company looks like real.
Yeah.
And these outcomes are, when I say look real, it is a combination of two things.
Yeah.
Performance plus validation.
Yeah.
Performance alone ain't cutting it. When I say performance plus validation at a portfolio of a fund, it means the company is doing well and there is another VC after you who has come in and given you an up round.
Yeah.
So it takes a combination of both of these two really for you to mark up.
Yeah.
So there were a bunch of markups which had started to emerge in the portfolio. Second, we had a 15% DPI. We got to that point where some small exits had happened.
That means for listeners, 15% of the 100 crores were returned back to the LPs.
That's right. It was a net return that went back to the wallets of the LPs. So now the investors know that these guys are investing and there can be exits which come their way. And there are still many more companies which are having bigger outcomes in store than what has been exited. Second factor. Third factor, all of these institutions come down to diligence heavily.
Yeah.
They would meet with the wider ecosystem. They would talk to our top 5, 7, 10 portfolio companies. Some of them would be okay talking to 2. The anchors who are putting in very large checks as a percentage of the fund size were leads in that sense, would maybe meet 5 or 7 or 8.
Understood.
They will also, the fourth thing that came about was that there was a team in place. It was Sanjay, Karthik and me at the time of the fund 1.
Yeah.
Here we also had added a few people. And also we had Adit in the fund 1 also who was there still.
Yeah.
So the team that was there during fund 1 stayed. Plus there were a couple of more people that had got added. And the attempt was that we were not trying to just keep running. We started to think about our platform seriously, our corporate effort seriously. We didn't put the names that exist today or tag them as much, but when somebody talks, they know that, okay, there is a person who is anchoring all the LP conversations. There is a structured effort to have somebody dedicated manage finance. There is a vision on portfolio support and anchoring as well, because at that point in time, there were three things that we were doing very, very actively, very, very consciously. One was supporting companies with opening up of our Rolodexes, a proxy for a go-to-market. The second conscious effort was to augment fundraising. We were a small 100 crore fund. There was only so much that we were going to invest into those companies. So you were going and opening doors on a consistent basis, taking that company's story to the rest of the world. Indian diaspora largely, a little bit outside. Then we had also set up these support arms of ours, which is Constellation had come into force full time. That's a firm that we set up outside. We incubated that. And this was the effort which was consciously done between Sanjay, Karthik and me in that order, literally owning each of those three pieces. And we were almost like a newer order of engaging with the founders. Until then, India's template was you will have a quarterly meeting, board meetings or whatever. Too young a company to have a board meeting. By that logic, you are on the board. Founders are the other two board members. Every time you catch up at a coffee shop, it's a deemed board meeting, isn't it? So we didn't kind of give a lot of seriousness to that so-called cadence of the board, but we engage much deeper than that. And each of the conversations, whether it was around GTM, whether it was a WhatsApp conversation to make introductions, or it was an email to open doors or support services, you were engaging with the companies not once in 3 months, but probably more like thrice in a span of 45 days. So that kind of engagement was showing and resonating, where when these guys come to do a diligence, they were able to really see that the founders need these guys and are vouching for these guys and the support that they give. So now that 4-point checklist gives a peak that these guys can invest reasonably okay. Looks like that portfolio will shine fairly well, along with some bit of exits and all that. It's in the works. And they have built a fair bit of cohesive chemistry with their founders, which means 2-3 things. One is that they will be able to stay on and support and engage deeper and have a better visibility on how to structure exits, etc. Second, it was also evident that the goodwill in the founder ecosystem is a small ecosystem that spreads heavily. So they will be becoming if not first, the first, second, third, fourth choice to be on the cap table. So there will be a by invitation kind of a thing that will belong to Blume. And you will be in a position to have a hefty pipeline for them to choose and make better investments. That's what it comes down to.
Can you summarize for our audience the 4 points again?
One, you are going down the path where you know to create a decent portfolio. 40% was a B2B, 60% was a B2C portfolio, and that has remained through consistently even now. Fund 1 through Fund 4. Second, there are exits which are coming. There are follow-on investors who have come in. So little bit of movement on your marks, which is multiple on capital invested, your DPI, so TVPI, all are moving. Portfolio construction, movement on the portfolio, so performance, portfolio, performance, team. There is a team that was there. These are not just 3 GPs or partners or 2 partners and a CFO running around. They have managed to retain a core set of team along with them and add it to the team as well with the proper vision. So I'll talk about just finishing the 4th point, and that is the founder goodwill in terms of the rippling effects. So it's all the 4 that matters. Somewhere in all of these 4 combined, there's a platform vision of Blume. So the why Blume was coming out a lot more clearly. And there are going to be people who are going to say that if not anything else, I will get a healthy 4-5x return in dollar terms from these guys. And If it is a little lower, I'll still be able to get a very healthy learning, because these guys will invest in 40, 50 companies. They will get into a lot of learnings. By just pursuing their quarterly reports and getting access to the portfolio will make us richer for our India strategy in the long run. We will be co-invest, hopefully. Not a lot happened, but people will have their own ways and means to rationalize and enhance their investment memos. So all of those things kind of were looking a lot more clear than what Fund 1 would have shown.
Understood.
So that's what matters. And what I was meaning to say and highlight earlier is on the aspect of the team and the platform vision. I think some of these things we have stuck to very heavily. When in the Fund 1, we were 5 members. In Fund 2, before even we went and did the first close, we had moved the team strength and were 8 members. So, and when we moved to actually 9. In Fund 3, by the time we did the first close, the 9 had become 18. By the time we did the Fund 4 first close, we had moved into our late 20s, early 30s. So what am I trying to highlight here? We were continuously ramping up of the team, not for the sake of checkbox. It is an unusually large team. But this is what was validating what we were pitching as a platform vision of Blume. Institutionalization of the firm, where today when you look at it, the team still has stayed. Sanjay, Karthik and me continue to be there. When firms have been imploding or breaking up or restructuring or whatever, there's one of the few teams that have stuck around. Have expanded the base of partnerships with people who have been long enough there also. Arpit has been with the firm for now
years.
Almost a decade. Similarly, Sajid,
for almost half a decade.
It's 6 years. And the relationship goes back even longer. Sajid, Karthik, myself, Alok, 4 of the top 10 members of leadership had worked together for a bit of time pre-Blume. So it was all coming together. Out of the other 6, there are 3 who have stayed for a long enough time. So that kind of approach to building the team, nurturing the portfolio, the platform that I'm referring to, was kind of looking like that has been seeded. That's exactly the reason I gave the example that it's like a Series A, where there is something which is looking like will work. Some of these may not stay as relevant, but most crucial things that are required in terms of getting the best pipeline. Why Blume? You can answer it a little better. Your founders can answer it for you as well. You don't need to answer every question. Can you create a structured portfolio and a performance? The numbers are showing. So if past perform numbers and track records and anything to go with, you will be able to do it if you continue to keep your basics and head in the right space. So that's where the 4-point summary.
Understood. And right now, by the time you went for your Fund 3, which was 120 mil, right?
Fund 3 was 102 mil.
Okay. And which year was this? You started raising this?
2018, we started raising in H1. We did the first close in September 2018.
And when was the final close done?
Final close was done in end of 19.
So almost 24 months again.
You're talking about marketing plus the closure. But broadly, if you take the fund raise period, that is actually from the point where you've done the first close till the final close, that has been shrinking significantly. What it looked like almost a 22 month period for Fund 1 came down a little in Fund 2. Fund 3 that came down a little bit. Fund 4 that was in lesser period, we raised 3x that money.
And Fund 3 was 102, closed in 2019.
That's right. So it took us a good 14 months from that phase of first close to final close.
Got it. And the same things that worked in Fund 2, the 4 points worked exactly the same in Fund 3?
With a little more intensity.
A
little more validation. The 4-point story in what looked like the Fund 2, you were able to corroborate all of that. Plus, you were able to enhance the story as well. Because you had added to the portfolio successes. Your DPI in Fund 1 had moved even further higher up. And it looked like your Fund 1, rest of the MOIC that you had built out, looks like convertible to a DPI. It doesn't look like a flaky vision to a 5x. It looks like, you can build it out to a 5x. So there was a lot more validation to the story. It is like exactly like a series B. And now you're moving into the acceleration and the growth mode. And that's what it showed. The LP base completely institutionalized. Here in Fund 2, there were still some
10,
corporate
15%.
VCs, and not only 10-15%, there were out of the institutions also, not everybody was like perfectly IRR driven institution with the proper diligence expectation. You had about another 10-15% who were still following on and making a judgment call on others who had led the round.
Yeah.
Here in Fund 3, 6 investors constituted $82 million of the capital. So in Fund 2, you had $60 million.
Yeah.
In Fund 3, you had 6 institutions pretty much rounding off to 82 million. So it is a big, significant difference vis-a-vis a Fund 2.
Understood. And then in 2021, you kicked off the 290 mil fund, the Fund 4.
2021, that's right.
And how much time it took, like 2021 to 2022?
So roughly about same,
14
about
months.
14 months.
From the first close to the
final close.
Final close.
It was, but the important point is that we raised 3x the money.
Yeah.
Also, critical for me to highlight here is that while it took a year, not 14 months, roundabouts.
And how much amount was the first close here in the fourth fund?
105.
Okay. That was quite a significant one, almost the size of the previous fund.
More than the size of the previous one. Yeah. And the other point to remember is, we raised this fund, kicked off this fund while we were in a lockdown.
Yeah.
So you're not in a position to go to any new investor.
Yeah.
You were not in a position to checkbox the 7-hour rule that I mentioned
Yeah.
a few minutes ago. You were not able to go and showcase or get them down to do a diligence for you. So it was against significant odds.
So what worked here in the 290 mil fund that you were able to raise?
I think the platform looked much more complete.
Okay.
Everything that was being said not only looked believable, but it kind of looked that from here on, it's about focus. We will not need to expand. So it will, I'm saying this, that in Fund 5 doesn't look like we'll now go and pitch for a $400 million fund. It was a steady state that we had reached in terms of team. We were sharing with the LPs that, while it is the 3 of us, but eventually we are going to add 2 more partners. Though 2 more partners are in the firm.
Yeah.
Those partners are also basically saying and vouching that we are there for together now. I think when you talk about the 290 million fund, by then, Fund 1 had gone ahead and completed some more exits.
So 1x?
1x had happened.
Okay.
It looked like rest of the exits are visible as well over the next year or 2. So the Fund 1 story will complete and mature.
Yeah.
The team build out on the investment leadership had fully matured.
Yeah.
You were not only 3 partners, but a very convincing 5-partner story was emerging.
Yes.
And that's what we mentioned to the LPs as well, that these are the 5 people who are driving the checks.
Yeah.
A template of that had been tried out in Fund 3.
Yeah.
Because we had a 5-member IC in that sense even there.
Okay.
Where Sajid and Arpit were cutting independent checks.
Got it.
So now it was just a formality.
Sure.
So whatever we were kind of indicating in the previous fund is now looking like a near valid point. The other thing is that even more validation from the portfolio. We had a few unicorns emerge as well.
Yeah.
When we were talking about the Fund 3, by the time we closed the Fund 3, we still had 1 unicorn.
Yeah. Which was which one?
This was Unacademy.
Okay.
And then we later on we managed to have Spinny, Slice and Purple.
Yeah.
It helps when the unicorns, not necessarily all, but some of them do have a certain DNA of managing their growth.
Yeah.
It looks like a manageable path from here on to marketable exits. Also, dragons were looking strong. So when I say dragons, I mean each of these 4 unicorns are dragons also.
Yeah.
So if sold at that point in time, they return the full fund.
Yeah.
So what you're talking about in terms of 8x and 10x funds, fund 2 looked like that kind of a promise.
Yeah.
And even today, in spite of the environment that it is, depending on when it corrects, I do feel that fund 2 is in a position where it can be that kind of an outlying fund. So it looked that fund 1 is on the verge of completion. It is just about a year or two away. Fund 2 is peaked pretty well. Fund 3, the portfolio construction had shaped up well. So from a portfolio construction of 60 odd companies, almost 70 companies, we were now at Fund 2, 45 plus.
Yeah.
Fund 3, not even 30.
Okay.
So you were having more and more accurate outcomes because your success ratios were talking about those. In Fund 1, the success ratios was less than a third.
Yeah.
Whereas in Fund 2, it was almost half. Whereas in Fund 3, we still have almost 3/4 of the companies which are still bustling.
Yeah.
So we are not in that zone where there's a vulnerability for an overwhelmingly large portfolio.
Yeah.
So that's the whole part. The other thing that helps is when you have investors who can repeat. So Fund 3, every single of those 6 institutions came back and repeated.
Got it.
Similarly, Fund 2 also, almost half the, I would say, check writers increased their amount.
Got it.
The other institutions consistently put that same amount. So there was that signaling which was very strong that there is a repeatable LP base which is moving on, and there's a consistency in building the rest of the platform as well. It is, while we were talking about a 5-member partnership, within each of them there is a small little pod which is kind of building up. We have moved forward by then, even now. So now we have 21 members on the investment team side and a full-fledged team build out. But by then, the offshoots were very, very clear. So it's like effectively a Series C, where you're saying that now I'm just required to start getting to a profitability mark from here on. Unit economics was visible last time. So now you are basically saying that Fund 4 is 290, or Fund 5 need not be 500 million. You will go with a $250 to $300 million story at that point in time, maybe as well. So people know that there is a sense of semblance of predictability and a rinse and repeat that will happen from here on.
Got it. But a 3x fund size of 100 to 290, I think you would have been the only Indian fund to do it.
I guess so.
Ashish, would love to talk about the top 5 portfolio companies of Blume and a brief about your journeys with them.
Sure. So I think when you talk about top 5, it's not an easy one. We have invested in about 100 plus companies. 75, 80 are currently live as of now. And they've always been that number at a given point in time. So, but I'll still make an attempt to talk about 5.
Sure.
For me, I think Slice, Purple, Turtle Mint. In terms of companies, I would just trying to diversify so that we can talk a slightly different audience. Therefore, I'm consciously deviating from your question of not talking about 5 of the top. I'm talking about 5 different heterogeneous examples, all of which I have a very deep appreciation and learning set that has emerged. So these 3 are in that zone where they have reached a pretty healthy scale. And then there is a Jai Kisan, which is on a very healthy track. And then there is an Exotel. So all, if you observe, very, very different journeys. A Purple was not the darling of the investors. If at all, the questions which used to be, there's no female in the team and you're trying to solve a problem in beauty. How are you going to crack it? These are the kind of questions have been thrown at the team. And credit to the 3 of them, between Manish, Rahul and Suyash, they've done a phenomenal job. They were also combating an era where customer acquisition was the only big game. We were emerged into the GMV era, where valuations would be how many X of a GMV run rate and all that. So they kind of were, in that sense, a different script in the portfolio. So the ability to discounting was not there, and the willingness to not be crybabies and so, oh, VCs don't get it. If I spend, I would have got it, was never the discussion in a one-on-one or a board meeting. And it is not just about the fact that we often glamorize the ability to fight back against all odds and all that, and kind of undermine what happens behind the scenes. In their case, they were very, very focused on making sure that you move on to exclusive brand partnerships which are on your platform, get higher margins for them, use data and go ahead and pick out what's the next brand that you're going to put out there. Create an own brand portfolio, not get carried away and say, okay, that's the big thing now. So we will be suddenly own brand story only. So it was not a typical, it was the ability to resist the temptation of not getting caught into narrative creation is a clear pattern amongst the biggest success stories of Blume. If you look at each of the 5 examples I gave and maybe the 10 others would have qualified, you would realize that this is a pattern. Same thing I would say goes true for a Slice as well. I would even go on to say that it's still early days. I'm not going to really jinx him. But I would definitely say that he's done well in spite of the ecosystem and not because of the ecosystem. So when I look at the journey, at any point in time, you look at it, he never had more than a few tens of crores. And it was only post the COVID scenario where he raised that large unicorn round is where he got an infusion which was like a 4-digit crore rupees of capital coming in, or $120 odd million flowing into the bank, into the balance sheet. So it is a journey against all odds and obsession around product and the customer, on how you prioritize that and deprioritized everything else. And that you are doing without going into like huge amount of discounts for an inordinate amount of time. There were discounts given, there was a customer acquisition, but it was on the banking of a product and the willingness to say that from here on, I might still expect you to be there and not keep buying your time on my platform. So then comes the likes of Turtle Mint. Uncool businesses. B2C is a cool thing to do. There is customer you talk and you get the margins in your pocket. But there is a template to building uncool businesses. The more unsexy and uncool the business, the better the sustainability and sanity. It is not about just being poster childs, like I said earlier. And Dhiren, Anand clearly exhibit that. So willingness to take a tough, gory problem, setting up a platform for the agents, and that has stuck with them. So it is a financial services play, having a larger vision. Each time, it was a moving goalpost with Dhiren. Each time you talk to him and he moves the expectation to another 2, 3, 4x than what he had kind of said in the previous year's review kind of. So that hunger and obsession about trying to be relevant to my TG was very, very high. Talk about Jai Kisan. Again, a fair bit of odds. Caught up in COVID just in the bank of the fundraise, including a broken term sheet where investors did develop a little bit of a cold feet. To bounce back from some of those things is a Herculean task. And once some of these things do happen, everybody else is going to, for a while, ask questions as to why did the others not come in. And at that point in time, we consciously went out and said in our first introductions that there has been this situation, so would you like to now come in? We were there. We did wire and we did support, as we have done with many of our companies. And then to kind of say that, okay, this is not just another financing business in the play. We will build a engaging, rock-solid tech backup to make it look like a scalable platform from where it can really be sustainable. So that orientation to keep the burn in the check, again, zealously fighting the situation hard. And then there's Exotel. It's a story which has been told many a times over. Just a couple of crores of capital, literally little above 2 crores, and riding it for 9 years and paying advance tax, which is more than the funds that you raise. It's as great as it can get from a tenacity point of view. Believe me, we have a dozen such stories. Fund 1, there are still a dozen companies in the portfolio which have not given up.
Okay.
These founders still come to work. They have employees. They are they're running a team. They are still having legit customers. And they have not raised rounds for minimum 5 years.
Okay.
And there are a dozen of those. So it's a very different audience. We are never short of inspiration.
And what about the likes of the unicorns? You have 5 unicorns today in your portfolio, right? 4. Which one are they?
Unacademy, Spinny, Purple, and Slice. And we have a couple of more dragons.
Okay.
So Grey Orange is a dragon.
Yeah.
That's the difference. It is not a unicorn, but it returns a full fund.
Yeah. And so, any learnings from these companies which you are now applying to your selection?
It will be 2 things is something that I would consciously avoid when I'm looking at I look after the fintech early stage side of it, or even the growth side. There's 2 hats that I wear. Apart
growth
from
for everything and fintech only for early stage.
Correct. So that's apart from the fundraising and everything else, right? So when you look at these companies at the early stage, you consciously need to make sure that you are not scarred by your failures. There is always going to be, you ask for 1, I promise you will discover 4 reasons why you should not invest in a company.
Yeah.
And you will get those 4 in the first 20 minutes. The more well-researched you are, the more thesis-driven you are, which we have become sharply.
Yeah.
You asked me some time ago as to what in a $290 million fundraise helps.
Yeah.
People were able to see the 20-odd thesis reports that we have put out.
Yeah.
And how kind of a depth of work and scientific orientation to construct a portfolio. So all of those things matter. But the problem around thesis is that you will start getting scarred by things that haven't gone well.
Yeah.
The way we should definitely try and figure out is what is that one or what are those 2 things that need to happen to take the company to the level that which it can be a game changer.
Yeah.
So disruption just doesn't happen because of pace and innovation. It happens because of sustained pace, sustained innovation, and the ability to sustain regardless of all everything that else happens. So I think you should avoid getting scarred. Learning is applied for sure, but getting scarred, no. The other thing that I do try and remind myself, and we do discuss during our leadership meetings and ICs is, ours is a job to make exceptions. You first make the rules and then you make exceptions. You can say, okay, it's convenient way of breaking the rules.
Yeah.
Not quite. When you say that, okay, we had a huddle yesterday for the fintech team, and we were discussing that the next company in the portfolio should be a company which is not doing credit. A company which is a little ramped up. I'm investing from the 3rd year.
Yeah.
And I have only 7 more years to exit. Now I can't be investing in what Sajid, one of our partners, calls it as a formation check, which is a company which is so early, product is in the ready stage of getting ready. It's formation check. So you don't want that. You don't want a credit company, and you want something which has got to do with a non-credit kind of a sector. So infra side of things and all. And in the evening, you met somebody who was violating all of these.
Okay.
Stellar founder. And you are basically scratching your head.
Yeah.
And
morning I discuss something and by evening I have to change my thoughts.
Exactly. So I don't know whether we will still go ahead and do the check.
Yeah.
But what I'm saying is that we are not ruling out ourselves of that investment. So you are creating those rules where you're going to draw dotted lines and say that these are the things that I'm looking for. But a thought never escapes the mind that, okay, if there is something which is not conventional enough or not as per my prescriptions, am I still going to ignore because it doesn't fit? I don't think we should get caught up in that trap. We should be willing to make exceptions. And that's where the nimbleness comes. The nimbleness, until the froth was there in 2021, was defined by how fast you can cut the check and land the money in my bank. I think nimbleness comes in the way we are able to evolve the thoughts and come to rationalizing an exception that you want to make, because you have discovered that one or two things that need to go right for this company to do well, and not get caught up in the web of one or two things that can go wrong. Every company is too early. There'll be hundreds of things that will go wrong.
And one more thought that I have is, in your successes, right? All the 4 unicorns and the other previous companies that you mentioned, there was an obsessive founder in always one of these companies.
These are teams possessed.
Yeah.
Right. So you talk to Gaurav Munjal today. The boom of edtech, the peak of edtech coincided with the peak of the froth in the ecosystem as well.
Yeah.
And both have gone.
Yeah.
It's not that people are saying valuations are a problem. People are also wondering whether edtech. He's never talking about straying from the path that, I need to do this to be able to make this a winning business. So there is that obsession and possessiveness about the space and wanting to make it count. He still, possibly knowing him and having heard a lot more, my interactions with him have reduced over a period of time as he has expanded his board.
Yeah.
Karthik has been much more relevant and deeper with him. So here, what I hear, he's still somebody who I believe will be thinking about an IPO. He might say that, okay, I will have to wait for a couple of years until I can defend and flow into a certain valuation to defend an IPO, but he's not going to stray from that path.
Yeah.
Talk about Rajan, absolutely the same thing. When people were trying to skirt around regulations, one of the rare founders who came and said, I agree, let's go and do an NBFC.
Okay.
When the opportunity throws up and you are saying that you operate in this kind of a constrained environment, you say, let's cut down all the burn and focus on turning the whole thing towards profitability. Before the tide changed towards that, he was making those attempts. So between 2 fundraise attempts, enough of our companies have become break-even so that they're insulating themselves from a potential challenge. You're not leaving the fate of the company to an investor who is not yet in the company.
Yeah.
Leaving it to a fate of the investor means can you create a bridge round which is enough for this cap table to support you? That is okay. But it is a disaster to leave the fate to an investor who is not on the cap table. That's a bad one. So there are some of those common traits on the fundraising and the strategic thinking side. And then there are a few traits on how they went about building teams. So we constantly saw that Purple would go and every possible round that they would make, they would go and hire somebody who is significantly a specialist. And the ability to make those calls earlier on are tough calls. And then having got people on board to get those people to stay for a medium term is even tougher. Because as soon as people figure out that, a 30-year-old something is trying to dominate beyond a point, he doesn't understand it as much as I do. I am the expert. I am the domain. The guys leave. And that kind of a spurt happened in startup talent acquisition as well, where people came out from large organizations and then kind of scooted back when tide started moving. So these guys have been able to retain their people in a meaningful way. Some have lost as well, but I'm not talking about exceptions that have not worked. I'm talking about the patterns that you can see in some of these guys. The other thing also which is noteworthy in some of these conversations is that they were never over-optimizing on their own dilutions.
Okay.
So when they had opportunity to raise capital, they leveraged it fully.
Correct.
They never kind of reached a point and said, I'll take less the capital so that I can dilute lesser.
Yeah.
In fact, I have a story where Manish was willing to do a secondary and bring capital back because of some compulsion that had emerged at that point. So you're shocked. You see founders wanting to do secondary so that they can enhance lifestyle or invest checks in the company. I can tell you a pattern that none of our founders have been those poster child in most of the founders rather.
Yeah.
There are one or two who have been, but most of them have not been in that zone where they're going left, right and center writing angel checks and all that. They will write. Everybody does. But there is a reason. They are going after a certain purpose and they are oriented to think in a certain way.
Ashish, the last part of the podcast I want to dedicate towards where you see the India opportunity, right? You just talked about middle of the pyramid, bottom of the top of the pyramid. What do you mean by that? I would like you to start with that. And the second is the career in venture capital for our audience.
So I think when you talk about opportunity sets, we have quite a few things moving. You put the last 12 to 24 months into perspective and look at what's happening. On the networks and infrastructure side, we have 5G rolling out at high speed.
Yeah.
I do believe that the form factor of any of the gadgets that we use today, any of the screens that we use today is changing.
Yeah.
There has been a significant shift and movement happening around the AI side of things. And these are things which are imminent.
Yeah.
On the back of these, I think it's very, very logical to imagine that everything which is impacted by these, which is media, entertainment, sports, financial services, healthcare, all of these things will have a significant surge.
Yeah.
And the opportunity sets are actually not to be looked upon as 130 crore, 140 crore population that we have, 1.3, 1.4 billion people. You will have to look at and break it up into micro buckets. So if you look at the Indus Valley report, the first time we did it, we had broken down into India 1, India 1A, 2, 3. That is basically the top of the funnel, the mid market and the bottom of the pyramid.
Yeah.
One will have to look at and dissect it the right way. Not the whole bottom of the pyramid is very, very attractive, but there are parts of which are very, very enticing. So that is broadly how I would look at it. When I now say that, okay, so thematically what I would see emerging, I do believe that there will be a lot more developments on the financial services side. We have already put out a report on CBDC.
Yeah.
So a big believer.
What is CBDC?
That is basically the central banking digital currency.
Yeah.
Globally, world over, countries are moving towards that.
Yeah.
So in a few years from now, I do imagine and dare to say that cash will be out of circulation.
Yeah.
Next year, I am anticipating some degree of retail penetration to also happen.
Okay.
This has an implication of how things shape up. So it is possible now for a lot of personalization to happen. Currency is digital, tracking is possible, security and privacy feature sets are getting enhanced, and there is AI. So the biggest theme that does emerge for me is personalization.
Yeah.
When I say personalization, across various fields, whether it is healthcare, pharmaceutical, which is medicine side of things, all of those things. But my partly biased, but partly actually favorite is the financial services side of personalization. You are trying to create a banking product so that it can be applicable to at least 1.4 billion Indians. You can now actually create a product which is applicable for even 0.5% of that audience.
Yeah.
Because the audience was never more than 10% anyway. It was a misconstrued market size. When somebody's pitching a market size on real estate, you talk about $1 trillion market size. That's a BS. One has to look at the profit pool. So you now can actually really get down to personalizing financial products. And that will be a big enabler and a game changer. When you couple that with digital infrastructure and architecture that we have, you will realize what I'm trying to say. So the opportunity lies at that across various matrices that we spoke about, top of the funnel, middle layer and the bottom of the funnel, across any of the other side of the 2x2. When it comes to the second part of the question, Siddharth, on the careers, on the VC side, I think people who look at careers in VC, whether you are joining as a analyst or a AVP, or whether you are looking to start up a fund, if you're looking at anything which is less than 15-20 years, it's a wrong foot forward. And the reason I'm saying this is only because as a fund manager, do realize that you will start a fund and then the second and the third, typically it's a 3.5 to 4.5 year cycle. The next fund comes within 3.5 years of the previous close. And in a decade, by the time the first fund has matured, you might have done 2 or 3 funds. By the time the fourth fund is ready, your LPs are going to say that you have earned carry.
Yeah.
So now you have to up the game in terms of your skin in
Yeah.
as a sponsor of that fund. So earlier we allowed you to put in a pittance and say, we'll give you money because you have sweat in the game.
Yeah.
Now they say you have money in the game. There is to be better capitalization by you as well. And then what you really make from the carry of the second fund is what determines your wealth buildup.
Okay.
So a fund manager should be the last person who wants to create a fund for wealth creation and instant gratification. So if I'm selling that second fund is when you really can hope for some wealth and lifestyle changes which are meaningful.
Yeah.
What you are talking about is a 13-year journey by default.
Yeah.
So that's why I said, if you're going to look at it from a less than that, it's futile.
Yeah.
And that doesn't happen unless you have mentally committed another 7 to 10 years.
Yeah.
Because each time you sign a fund, you're implicitly committing 12 years. Actually committing, not even implicitly committing.
Yeah.
So any thought process as starting up a fund which is less than 15-20 years is, I would say, wrong foot forward. Why does the same logic apply to an employee as well? If you're an employee on the fund, are you going to make do with just being a employee and not want to have the aspiration of being a partner or an investor who's driving the part of the strategy?
Yeah.
By all means, that takes the same amount of time. That whole fast-paced things about trying to say, I discovered a company and I had a great track record, so you fast-track it into a partner role. But after that, so again, even as an employee, with the lens of wealth creation, it is foolhardy to enter the space. Like we have said it for founders, that you don't come in and there are jokes and memes around it. The founder comes for the pain and gets rewarded with the gains. It's true for VCs as well. You're a lot more hedged. So count your blessings that, you have the right orientation and it aligns with not so much of pain and a binary outcome that a founder has to go through. People often compare careers between a company and a VC.
Yeah.
People say that, okay, if I'm joining you, I'm going to get only 20 odd lakhs as a salary as an analyst, vis-a-vis some other fund where I can actually get 2x of that. Or I join a startup which is Series A and he will happily offer me a partner's office role. Okay, fine, please go. If monetary consideration is a driver, we are never in the reckoning. If you are basically trying to say that, okay, I have these opportunities which are non-monetary in nature, now let's compare and please educate me, then we can have a conversation. So, and this is not something that I'm saying to steer away from the battle. I'm basically announcing that there are different turfs on which the battle is being fought and the financial reward is not the turf on which you want to fight that battle. Yeah. And even for a budding fund manager, as you are trying to build out a team and talent, please look at the other tools that you have. You have carry as a pot. We have been given this feedback that you're over generous on the carry distribution to the team in general.
Okay.
And I think it's better to have that feedback than organizations doing a DD at your back and saying, does he share rewards at all or no? Or he or she. So I think that using that well, how a person reacts to carry as a form of reward gives you a lead indicator on the orientation of the person.
Yeah.
But if you're just going to play it on instant gratification, this is not the field to be, whether in a startup, whether in a VC, whether in a capacity of a GP. So that's broadly how I would think about a younger self.
And what about a lot of folks who had 3 to 4 operator experience now want to join a fund, right? The right skill set to develop for a fund, what would that be?
So I think a fund should have a healthy mix of entrepreneurs, operators, people who have come in from consulting / advisory mindsets. And let's not get cliche about it. We have not built it that way. So, for example, today when you look at a typical preferred resume or a JD or a stipulation as to who you are seeking, we consciously might select somebody who does not fit the bill on some of those criteria, because the person has to check more fundamental boxes rather than just about the ranking at the IITs, than the exact experience that you want or the pedigree of college that you went to. Of course, we are not saying that all those don't matter. They are a starting point, but they are not the end in itself, is what I'm trying to highlight.
Got it.
So if somebody is not in the top 20, top 50, or is not a ranked person at all, maybe not gone to an IIT at all or IIM at all, it doesn't matter. Blume is a living example where a team has been built with people who, leadership has been built with people which are unconventional from that standpoint. And these are unconventional, but they can give a run for the money to best of the incumbents and competitors. So when it comes to building the ecosystem in the industry, whether it is working in forums with along with the government authorities and IVC and all that, you will see what the Blume contribution and leadership in general is contributing. So there is a ability to go down that level and go for not those perfect choices, but the relevant and the right choices.
Got it. And once one has done away with instant gratification when they want to enter the fund as
instant gratification and sense of entitlement, both you have to do away with if you have to succeed in the ecosystem. The sense of entitlement is something which really puts you into a very weak
What is the sense of entitlement?
I am IIT plus IIM, 5 years worked in 2 of the unicorns. Third unicorn is willing to give me a job. So you have to give me 1 crore. Great. If he's giving and you are willing, why don't
you join it?
Absolutely. Instant gratification is, I don't care about carry, I don't care about ESOPs. And I want everything in the salary today. That has to go away. Sense of entitlement is that this banta hai, that nahi chalta hai. Banta hai, nahi chalta hai.
और ये मिलता आया है.
हाँ, तो क्यों नहीं? नहीं हो सकता है. A fund which is a $50 million fund. And it is not so long ago we ran with AUM of $83 million. 2018 tak, when we did the first close in September. $83.33 million of AUM. 2018 September. And now it's barely 5 years. It's in 5 years that we have raised the other 2 pots of capital, right? So we have not, it's not so long ago that we were in the same boat. How can I afford talent and pay that kind of salary? Then what do I go and do for the rest of the institution build out? When you're coming in the VC, if you're coming with the gloss of writing a check, like I said, it's a wrong foot forward. You are in a job which is the highest level of intellectual sales.
What do you mean by that?
You start a fund, you're going and selling your past and get somebody to take a leap of faith on your CV and take money as an LP. The next time you're raising a fund, you are selling your track record of building a portfolio. The third time you're raising a fund, you're selling your track record of performance. The fourth time you're selling your track record of building a team. So you're only selling. Between each of these 2 moments, between selling your CV versus selling your track record of portfolio construction, you're selling to a team member, saying that why we can have a good job together. So it's selling to a co-founder. You're selling to an employee to come on board and be an analyst for you. Because that same guy will probably go to somebody who's raising the second fund. Between somebody who's raising a first versus a second fund, people are willing to get in different sets of talent. So you're competing. If I look at my $83.33 million example in 2018, and you in your current plan of $50 million next fund, you and I will be competing for roughly the same talent pool. And the guy will prefer me over you because of his bias that there's a relatively more AUM, there's a relatively more stable fund done. So people look at those kind of things as well. So that is what I am referring to. You're selling that why this is still good. Then you're selling to a founder that why you are the best check to get or the best name on the cap table. Then you're selling to a co-investor to come in at a Series A and give you an up round. So it is a sales process all round. So I would say that it's the most intellectual sales job. It's the most, if we're looking at biggest challenge from a sales standpoint, VC is the way to go.
What I tell people who
it's not as buy-side as people want to be. Then perfect buy-side is a PE job.
What I tell people is people who want to come into fund, and this is the last part, right? And have an expectation that they'll be cutting checks, building thesis. I said, a fund is a 5 muscle job. The biggest muscle, first muscle is sourcing. The second muscle is judgment, right? The third muscle is servicing the founder. The fourth muscle is marketing the fund, right? And the fifth muscle is fundraising for the fund. So if you do expect only to be sharper in one of these muscles or two of these muscles, then you are not right fit for the fund. Or if you don't want to develop any of these 5 muscles holistically in your journey.
Maybe okay that you will not do a fundraise.
Yeah.
But marketing of the fund always.
Yeah.
And marketing of the fund does not mean that you are praising the fund all the time.
Yeah.
When a founder comes and says that I have a term sheet from a 3x the fund,
Yeah.
are you going to give up and say that I'm conceding to a better institution? You have to acknowledge the fact that you are lazy and you're conceding to a bigger institution. By that logic, Afghanistan should not be having a right of win and to hopefully defeat Australia.
Yeah.
Right? So you're basically conceding and willing to be lazy.
Yeah.
So it's perfectly fine if you are not going down the path. If you're a GP, yes, it's a perfect 5 muscle job. If you are coming as an employee and each passing cycle over the next 15 years, 20 years, you'll have to develop that extra muscle.
Yeah.
So that's how I would put it. That the 5 points that you mentioned are perfect and relevant. Person joining in can start with maybe 2 and each passing cycle add 1 more.
Yeah.
But a person starting out as a fund manager, all of those are super critical. And not to forget the fact that when you are looking at the founder, we say that, it's servicing the founder. But how relevant is the service? We take it easy and say that it's founder friendly. But often we have tried to get a person to appreciate that founder friendliness of Blume does not mean that we are acceding to the founder's request all the time. It's about a partnership, and the founder respects our feedback, even though it might not be what he wants to hear. And the friendliness is about the best interest of the business and the company at all points in time, of which founder is the best and the biggest custodian. So that's the friendliness and the definition that we are wanting to put on the table. So that 6th muscle of sensitivity and empathy is becomes super crucial. Again, I go back to my point of sense of entitlement.
Yeah.
I am a VC. So what? You will still have to pitch. You'll have to still get into the hustle of supporting that guy and do the bits that he's not equipped to do.
Thank you so much, Ashish. It's been such a fantastic conversation.
Thank you very much, Siddharth. All the best.